Well, welcome back to Markets Today. At the moment, we are getting some breaking news on the Reserve Bank announcing a bunch of steps to develop the fixed income and the currency markets further. Some of these are that banks will be now allowed to provide more credit enhancement to bonds. Basically, what it means is if the bond guy, the bond issuer doesn't pay back the money, banks can step in and provide, say, I will take 50% of the loss. So it is called what's called a credit enhancement. Originally, they could provide only 20% of loss guarantee. Now they can provide up to 50%. Among the other steps that are being contemplated is that brokers will be allowed in the corporate bond market. At the moment, brokers don't participate in the corporate repo market. There's hardly any corporate bond repo, but it is done directly by banks or by primary dealers. Now, brokers will be allowed. In course of time, they will also make legal amendments to ensure that the Reserve Bank can accept corporate bonds in the what is called the LAF window, the liquidity adjustment facility. At the moment, only government securities are accepted in exchange for money. If a bank needs money, it gives collateral of government securities, and RBI provides cash. On a daily basis, these repos happen. Now, even corporate bonds will be accepted, but that's after some suitable legal amendments. They have also allowed more access to foreign investors, FIIs or FPIs, directly to access the NDS OM. Now, the NDS OM is like the Bolt, BSE Bolt for stock markets. The NDS OM is the exchange trading platform, the trading platform for government bonds. Until now, foreign investors had to invest in it or buy and sell in it through either primary dealers or banks. Now they can do it directly. So foreign investors are going to be allowed, which will mean more liquidity for government bonds. There is also easier access of several participants, residents who play in the commodity market. They can hedge their transactions up to a limit of $30 million at any given time in the Indian commodity exchange market and in the currency markets. These are some of the steps taken. There are further steps taken as well, but let me get some expert opinion in before I read out everything. Manoj, Rane, the Managing Director, Head Global Markets at Barclays, has joined us. Manoj, from the little I read, do you think that this is going to make a seminal difference?
Firstly, it's BNP Paribas, Latha, not
Sorry,
Barclays,
I'm sorry. Yeah.
That's okay. So, I don't think it's going to be making much of a difference. I think what the market was really looking forward to was for, corporate bonds to be permitted under LAF. Having said that, I think the report itself, the corporate bond market report under SEBI's aegis, was actually fairly clear that they were waiting for the secondary market in repos to actually improve prior to allowing it for LAF. But, the market was really expecting it in the backdrop of FCNR redemptions and provision of additional liquidity, issues relating to liquidity coverage ratio, etc. It would have certainly helped banks. But having said that, I think not too much in terms of what you have announced, you have told us so far.
Okay. Permitting brokers in the repo in corporate bonds. At the moment, participation in repos is restricted only to regulated entities like banks and primary dealers, mutual funds, insurance companies. Now they're going to allow, corporate bond brokers, that is money market brokers, as market makers. Will that make a difference? And they're expecting to meet their funding requirements as well. Arising out of this market making activities. They will issue an enabling circular today. Will that help?
So we need to see exactly what this means, because if it means that they want to allow brokers to act as a kind of liquidity providers in the corporate bond market and hence participate in the repo. If that is the point, or is the point really is that repos earlier were to be done directly between counterparties and now brokers can facilitate the same?
It looks like brokers can facilitate. In fact, if they have to be market makers, then it is a little more than just facilitation, isn't it?
Yeah, that's right. So to that extent, if it's merely for brokers to act as brokers, which I presume that's the idea, because for them to push brokers towards actually starting to market make and allow them to participate in repos, I think that might be a little extended. I didn't even see that as a part of the committee recommendations. But, Latha, the point is that corporate bond repos haven't really taken off. Fact
So
is that
so market making should help in that case, isn't it?
So brokers' participation to facilitate might help a bit. Having said that, there are a whole lot of issues, which we may not be able to go over just in the course of the call, which prevent repos and corporate bonds from taking off.
Okay. Well, there are a couple of other announcements as well. So while I read them out, Manoj, just wait. We also have Ashutosh Khajuria, the ED of Federal Bank, joining us, former doyen of the Treasury of SBI as well. Mr. Khajuria, the big thing is FPIs will be allowed to trade in NDS OM. As well, FBIs will be allowed to trade directly in corporate bonds in the OTC segment offered by stock exchanges. Your thoughts?
It's for me.
Yes, Mr. Khajuria.
Yeah, I think on the first part, on the broker part, I think that brokers may not be the market makers here. The way they were intermediating for the spot deals earlier, before the advent of NDSOM, the electronic broker rather, if I can use that word for that platform, I think they would be the matchmakers, not the market makers. Market makers ultimately have to be the borrowers and the lenders. As regards FPIs participating in NDSOM, that's a welcome move because gradually their share in investment in Indian debt is increasing. And with opportunities being there and more stability in the currency markets, particularly the rupee being stable, there could be more attraction of FPIs coming here, and then they can generate liquidity by repoing.
Okay.
So I think their participation would certainly increase the liquidity in the market.
Okay. You expect more liquidity in the GSEC and in the corporate bond market? FPIs are going to be directly allowed to trade in corporate bonds?
If that be the case, because I haven't read the full, this what exactly has been accepted from the Khan Committee recommendations and all. But then I think if they are permitted to participate in repos in corporate bonds as well as in GSEC markets, certainly it's a welcome move. They are now major players. They are major investors in Indian debt.
Okay. The other announcement is that individual investors having demat accounts with depositories have been allowed to trade directly on the NDSOM starting August 16th. Has that helped?
It would take time because unfortunately, despite several measures being taken by RBI, FEMDA, various banks to bring retail investors to GSEC market, it has not succeeded to the extent it was expected. And on one hand, you have no credit risk there. People are comfortable with taking higher credit risk in the form of investment in equity, but somehow GSEC market couldn't attract them. Okay. Maybe this is another attempt to do that. I wouldn't comment anything on that. Let's see, how it progresses. But it's one more move towards that.
Okay. Well, similar questions to you, Manoj. Do you think you're going to see a goodish bit of liquidity if FPIs were allowed in the NDSOM market as well? They're allowed to directly buy corporate bonds as well, more retail participation in government securities. I believe that is being permitted from 16th August itself.
So, to take all your 3 points one by one, as far as FPIs are concerned, they had to trade on the exchanges, which meant that they had to largely only operate through brokers. Also, they could, of course, transact directly with PDs, so effectively in the primary market, etc. The fact that they are now allowed to get on the NDSOM means they can trade directly with counterparties. It also is good because the NDSOM in any case is a transparent system. So the purpose for restricting FPIs on exchanges was, of course, interests of transparency, right? So that the data is available, volumes are available, etc. So I think NDSOM being as transparent as it is, I think it's a much awaited and long overdue measure, and I think it's welcome. It will certainly provide liquidity. As far as corporate bonds are concerned, there is some extent of FPI participation, but Latha, really the problem is that there is no credit market in India. So, there is no CDS market. There is no way for FPIs to really hedge their credit risk. So far, the trading in corporate bonds or investments in corporate bonds is extremely opportunistic and very yield related.
Okay.
So if interest rates are expected to move down or there is an arbitrage,
Okay.
it's only then that FPIs invest in corporate paper. So I don't think this might substantially add or detract from the existing liquidity in markets.
Okay, well, there is a little more coming. The RBI is also allowing market making in government securities. To begin with, the PDs will be offering two-way quotes in semi-liquid paper. I guess the PDs are already doing a little bit of market making in primary issuances. But now they will offer two-way quotes on NDSOM and OTC platforms in semi-liquid paper as well. Now, will that ensure that, at the moment, you have 5 papers where there is some liquidity in government securities. Will that ensure more liquidity, Manoj?
So, as far as PDs are concerned, anything which happens more involuntarily rather than voluntarily, like, PDs are being told to do this, it's always going to be a challenge. The underlying issues relating to liquidity are many, right? Like,
Okay.
for instance, there are not sufficient issuances, sufficient floating stock, etc. But just one quick point, Latha, about...
Yeah, for that, they're encouraging reissuances. So actually, this scheme becomes effective by end September 2016.
So you're absolutely right, Latha. The problem is that there are not so much of debt issuances. How many companies would actually be doing large issuances during a year? 10, maybe 12. So, the underlying problem of lack of floating stock is very much there. But just one quick point on your retail question.
Yeah.
Because the retail has kind of vexed everyone in terms of why it has not taken off.
Yes.
But, there's clearly, there is an equity cult in India, but certainly not a debt cult. And, there are other things, like, for instance, mutual funds, there is a tax advantage if you go via the mutual fund route. As a result, there is not a level playing field between direct investment in debt and going indirectly. Plus, tax-free bonds. There's a reference in the Khan committee itself to the possibility of again tax-free bonds coming up, and which might again compromise general debt market. So there are certain more issues than merely this.
Okay. Well, Mr. Khajuria, your thoughts? I mean, for retail participation, they're going to make it seamless. If you have a demat account in a depository, you can seamlessly buy and sell government securities. So you get an entry into the NDSOM. Do you think at least some HNIs will be interested?
Yeah, I think that is one segment which can get attracted because whatever said and done on NDSOM platform, you have the highest liquidity. On exchange platform, you do not have liquidity as such, as far as GSECs are concerned. Earlier also, 2 depositories, NDSL and NSDL and CDSL, both were having their, SGL accounts with RBI. And through that, retail participation or retail investment was possible through exchanges. But somehow it did not attract the investors on the exchange platform. Now with the NDSOM, where you have higher liquidity and you have this separate platform there, and CCL also taking a lot of initiative to, educate the retail investors and prompting all the participants to, at their level, mobilize the retail investors, there could be some improvement. But I think pudding is anything. Let's see, what comes, as a result of this measure.
Okay. I think the big kicker will come when the corporate bonds are accepted in the LAF window. And the Reserve Bank's own statement is RBI is actively considering corporate bonds as eligible collateral for liquidity operations. The process to make necessary amendments to the RBI Act has already commenced. Will that make a very big difference, Mr. Khajuria?
That's going to make a real big difference. It's going to be a very revolutionary step, because if RBI starts accepting corporate bonds, maybe of a particular pedigree, of a particular rating, it's going to really make a lot of difference, because then, you would not be hesitating and, warehousing these bonds or holding these bonds beyond the opportunistic moves, like, what Manoj was talking about, expecting these yields fall. You could also keep it as a liquidity measure. So for LCR and also, it would become more, liquidity generator. And that is very, very important. On the semi-liquid GSEC bonds which you were talking about, the PDs participating, I think Manoj has rightly put it up. If it is not providing anything on the table for the PDs, it's going to, they may make two-way course, but these spreads would be very high. And these broader spreads are not going to help. It's not going to develop the market unless they have something on the table. So like reissuances and all, if it becomes exclusive for them, that could be, something more for them to, actively go for it.
Okay. Well, let me come back to this partial credit enhancement. What's your sense, Manoj, if the banks are allowed to give credit enhancement up to 50% of a bond issue, do you think there will be more buying and selling in corporate bonds? Or for that matter, even CDS?
So what actually a higher credit enhancement implies is possibly ratings of subpar issuers would certainly improve. Like, for instance, someone who was earlier a single A could very well come into a double A minus or something.
Yes.
Because which would be great, right? Because then you have a slightly wider universe of issuers, and which is very good, because right now there are indeed very few issuers. It's very concentrated. So that is one advantage. The other thing, of course, we need to wait and watch the fine print. Is what impact does it have on the the guy who is enhancing or providing the credit enhancement, like the bank which is doing so.
Yeah.
Does it mean how does it impact on its own capital? What is the weightage, etc. Because then if it's not going to be substantially different from lending directly to the company, it may not really enthuse too many banks to provide this.
Okay. But what is the, Mr. Khajuria, if you would know, at the moment, is it different credit enhancement and direct loan exposure? Do they attract different risk weights?
I think, we have to look at it from that angle, that it generates, without parting with funds and going through a non-fund type of arrangement, like bank guarantees and LCs, which banks are quite used to, and they've been issuing. So this credit enhancement comes more like a bank guarantee.
Okay.
It's a non-fund based thing where fund is actually provided by the ultimate investor.
Yes.
So these could be pension funds.
So the capital for it will be less, risk capital required will be less. Is it already less than it is, at the moment 20% enhancement is allowed?
Yeah, but it's immaterial whether it is a fund-based or a non-fund-based. The capital requirement would be a function of the rating of that particular borrower. So if it is a AAA, then only 20% risk weight is taken. If it is AA, then 30%, and if it is A, then it's 50%, and triple B, 100%, and so on and so forth. So that formula is not getting changed.
Okay.
What actually would happen is you will have more players investing and more disintermediation happening, and more players coming into investments into corporate bonds, and banks will save their funds.
Okay, there is another point coming for bankers, and you may be more interested in it, Mr. Khajuria, as you are a representative of Federal Bank. You can now, the rules are going to come in very soon, where you can issue Masala bonds in lieu of Tier 1 and Tier 2 capital. At the moment, I guess it's more shorter term paper that you guys are allowed to issue. But now the rules are going to change, with banks being allowed to raise even Tier 1 capital and Tier 2 capital, so perpetual debt as well as short term Tier 2 debt in the form of Masala bonds. Considering the stability of the rupee, you see a lot of appetite there?
Yeah, there could be. If the rupee remains stable, then I think rupee-denominated bonds would have definitely more demand, because yield would be higher, and there is no fear of sudden depreciation or bottomless pit, as we call it. Suddenly when it starts depreciating, it could be anywhere. So I think if currency part, that stability is there in Indian rupee, that definitely is going to attract more investors overseas as well. And it's not limited to Masala bonds being issued by banks alone. In this case, banks are permitted to go in for their capital enhancement, capital augmentation.
Yes.
In the form of,
So you think that's a fairly important window that will be now available for banks? It will make it easier for you to raise capital through Masala bonds?
Ultimately, it will be a function of the investor being enthused by it. I mean, issuer would always be ready to do that. But what price is required to be paid would depend on what type of perception they have got about stability of Indian rupee.
Okay.
And at the same time, what net expectation of rate.
Okay, so net, okay, so these are the various steps that have been announced, and I'll just rattle them off, and I want your final comments. Partial credit enhancement limit is being raised from 20% to 50% of the bond issue size. Banks will be able to raise tier 1 and tier 2 capital by raising it from a foreign market through Masala bonds. There is also going to be easier access for those who access currency derivatives market. So the limit of 30 million has been put in for the moment. As well, you've got some more, future expansions. That is the government and the RBI looking at rewriting the Reserve Bank Act itself to allow corporate bonds to be accepted as collateral. And then, of course, repo in corporate bonds, you're going to allow, brokers. FPIs are going to be allowed to be trading in NDS-OM as well as in the OTC market, and further retail participation to make it seamless. These are the most important measures that have been announced. Okay, another important measure. So at the moment, corporates, when they lend to through the GSECs as collateral, there is a 7-day restriction for lending. Now that restriction goes, they can lend for an unlimited period. These are the main announcements that have come in. Okay, broadcasting of auction results will be at a fixed time. At the moment, it comes whenever the RBI feels like. So there'll be a fixed time announced for the results of auctions of T-bills and of government bonds. That's the set of measures. Jayesh Mehta has also joined us from Bank of America Merrill Lynch. Jayesh, I just rattled out all the measures to you. How does it look? Is this a comprehensive improvement of access and liquidity?
No, it's definitely some improvement to access and liquidity, but I frankly looks like a little bit more lot of challenges there. So to put some of the things, of course, fixed time announcement of auction results will be cherished by all bond traders.
Okay.
At least they can have their lunch in peace. So that's the first positive news of it. I think even the tier 1 and tier 2 capital bonds by banks, that's also pretty good. Only thing is one has to see the pricing versus their international pricing versus the local borrowing pricing. So
for which one?
The tier 1, tier 1 for the banks.
Yes.
So one will have to see, because there are senior secured bonds of Indian banks abroad. That pricing versus 81 pricing and 81 pricing onshore, right?
Yes.
So I think that's pricing is going to be a very crucial part of that.
At the moment, banks don't issue these bonds abroad at all, isn't it? They only issue green bonds.
No, they issue their offshore branches.
Okay, MTNs,
Yeah, so they issue this, so it's ultimately the same credit risk, right?
Okay.
And they issue it from their offshore branches. Then they are senior secured.
Okay.
They're senior bonds. So not secured, but they are senior bonds. And they are also trading at attractive yields. So one needs to see the effective pricing, what they are getting today from the domestic market, and what the investor expectation for this pricing offshore would be.
But since this is a new category, will it be a little lower yield if the same banks borrowed from the global markets?
That's where I'm finding it little, because global guys would compare the equivalent dollar bond, which is senior.
Okay.
And that is right now, intuitively, if I look at the hedge price into rupee, intuitively trading at more or less just little low under where they are able to raise tier 1 bond in India.
So it's not necessarily attractive.
It's not necessarily attractive. So maybe they might have to give a little bit more pricing to 81 and rather than what they are issuing to Provident Fund.
What about this FPIs being allowed into trade directly in the NDS-OM?
It is good, but again, it's like we're not really expecting most of the FPIs. There are some hedge funds who are kind of active. Most of the FPIs to be really trading intraday and stuff like that. So how much additional benefit they get out of having access to NDS-OM directly, I'm not too sure about it. And at the end of the day, typically whenever, most of these long-term investors, they buy, they would like to get a fill order done, right? So rather than putting their bids on the screen and being on the front of the screen and stuff like that, they would actually like a market maker to give him a two-way quote, because on an NDS-OM, typically the market size is 5 crore, and then to get a fill. So that's one has to see how much happens on the screen.
Okay.
But I think parallelly, but particularly for the long-term guys, the fill will work.
Okay. Well, let me just get another comment in from all three of you. This is easing access to the forex market for hedging in the OTC and exchange-traded currency derivatives. What the Reserve Bank is now saying is it will permit entities exposed to exchange rate risk, whether resident or non-resident, to undertake hedge transactions with simple procedures up to a limit of $30 million at any given time. 30 million. The exposed person will be free to access any market, OTC or exchange, and use any of the permissible products at his discretion. The AD banks, authorized dealer banks, will monitor the adherence to the limit of $30 million on the basis of periodic reporting by the exposed entity. In addition, they will also be, these resident and non-resident entities will also be allowed open position limits up to $5 million. And this is both OTC as well as exchange-traded market. What's your sense, Manoj? Do you think immediately you will see a lot of, movement between commodity trading, currency trading, as well as the OTC market?
Honestly, actually, this is apart from the corporate bond-related measures.
Yes, this is separate.
Yeah, of course. But having said that, I think this is, in sync with what, corporates and market have been asking RBI for quite some time. It's got to do with the fact that people who have, who are commodity traders in India or commodity manufacturers or someone who deals in, petroleum products in India, but they may not be importing or exporting, but they're clearly exposed to the overseas prices because, they move in sync with the overseas levels. So to that extent, I think it is good. Having said that, it's 30 million is quite a fairly insignificant amount, and to that extent, I don't really think it's going to be a market moving kind of event. And as is normal, custom with RBI, they are starting with a smallish amount, and hopefully they'll go and see how it goes in the future. I do not expect it to play much of a role in terms of market movement, but I think it's overall good considering that we are in a fairly stable macroeconomic and currency situation. So it's possibly the right time to introduce something like this.
Okay. And the final part is something which is more a promise in the future. There is going to be a working group which will review the guidelines for hedging of commodity price risk by residents in the overseas market. I'll just read that to you. Exposure of Indian entities to commodity price risks has been accentuated with the integration of the economy. It is now proposed to review the existing framework for hedging of commodity price risk in the overseas market with the objective of addressing commodity price risk management by Indian companies during the development phase of domestic commodity derivative market. The review is proposed to be carried out by a group of members drawn from RBI and SEBI. Now, this looks like it's at the moment only a review, but eventually Indians will be allowed to hedge more in the global markets as well. Jayesh Mehta, comment on that. It's only a review group.
No, there are two things to this. So, the 30 million...
that is in the domestic market.
No, that is for FX.
Yes.
Okay. That is for exchange-related risk to hedge.
Sorry.
And what they have done is, at least for 30 million, at least one good thing is they have accepted that for the rest of the things, the procedures are not simplified, but at least for 30 million to undertake the hedge transaction by corporates on FX side, they will make it a very simplified procedure.
Yeah.
So that's part one on the FX. The second part on FX, over and above this 30 million, the corporates can run an open position of up to USD 5 million.
Okay.
So up to 35 million, 30 million will be simplified procedure because right now the procedure for hedge document, because corporates are allowed only to undertake hedge. So 5 million will be over and above their hedge. So that's an open position they can run.
Okay.
And up to 30 million is more on a simplified procedure as compared to the normal hedging which they do.
Okay.
And the commodities part is completely separate because there is indirect risk of Indian corporates or Indian resident on commodities, even though they may not be directly exporting or importing, but it does impact them. If you are a local, say, a steel guy or something, but it is the steel prices are decided globally.
Yeah.
So for that, there has been asked from the corporates from long time that there is a indirect commodity price risk. And
Yes.
for that, they are setting up a working group
Yes.
to review that, how we can rechange and reshape that guidelines of hedging of commodity prices. So these are the two different things.
Two separate things, yes.
Two separate things. And so commodity price risk is definitely there with a lot of Indian corporates, even for a lot of PSUs who may not even directly deal.
Oh, yes, actually, all the oil PSUs are exposed to it. But here, there are no steps announced. They're only going to review it.
It's a working, working group will look at it and they will come out with, so there will be a new working group. So they will review the existing guideline and they will come back with a suggestion as to, should we allow more liberal their situation.
Okay.
But on the FX side, it's definitely, at least for some smaller corporates, it's going to be much easier.
Okay.
And larger corporates, anyway, their documentation is anyway quite simplified. So this, in a way, will help a lot of smaller corporates, particularly the 30 million and 5 million, to actually manage their hedge
Actually, there is a separate set of guidelines that have been released on enhancing credit supply for large borrowers through market mechanism. I don't yet have the details for that, but I guess it's going to be easy for borrowing from the markets as well for large borrowers. There's another point that I wanted to read out to all three of you. Removing the 7-day restriction for lending by listed companies in market repos in government securities market. Jayesh, you want to take a jab at that?
Yeah, it is good for corporates. They will have avenues to even park their short-term money. Of course, one has to see the operational ease of it. If the operational ease is met out, it will be also competing with some of the short-term money market funds and also with bank deposits. Not great news for bank deposits per se. But definitely great news for corporates. But I'm really a little bit perplexed. On one side we talk about creating term market and stuff, and on the other side we try to liberalize by reducing deposit tenor from 90 days to 7 days, and this is indirectly allowing access to corporates to park their money overnight, which of course was there through money market funds also. But
no, I didn't get this. I didn't get this. The rule says currently listed companies can lend through repos in GSEC market for a minimum tenor of 7 days to banks and PDs, which constrains their participation. It is now proposed to allow such companies to lend through the repo market without any restriction.
Yeah, so earlier the 7 days restriction was so that it was not conflicting with the deposits.
Okay.
The deposit is minimum deposit a bank can offer. It has to be 7 days. A bank cannot offer 3-day deposit to a corporate.
Okay.
So, so therefore minimum deposit, otherwise, it remains in the current account.
Yeah.
Or you have to go to the money market.
So now what difference will it make to a bank?
A corporate, instead of putting that 7-day deposit with the bank, he can now actually have flexibility. Typically, corporate would manage, would do rolling 7-day kind of thing. So 1 day, 2 day, 3 day, so that every day he has some maturity coming in.
So more liquidity available to the bank.
More liquidity tool available to the corporate. For banks, it will definitely compete with the deposit side also, because bank will have to give attractive rate for 7 days deposit to match with the repo rate. To compete
with the corporate.
Yeah, to compete with the repo rate on government bonds for corporates.
Okay. Manoj, Rane, last thoughts from all of you. When all these are implemented, do you see much more liquidity in government bonds, much more liquidity or ease of doing business for corporates? What's the net takeaway?
See, my immediate reaction is that these are all moves in the right direction, but there were a couple of things I think which will be slightly disappointing. One is that the market was expecting that the repo in corporate bonds under LAF will be permitted, but that's not happened. So that's a little bit disappointing.
But that's on the way.
Yeah, but it's not happening immediately. Looks like it will not happen prior to the FCNR redemptions, because the market was looking towards that, because there are issues on the ALM side in terms of liquidity coverage ratio, etc., relating to corporate bonds. So that's one part. The second part is that the report had strongly suggested, and we've had many discussions with RBI on this topic, that working capital limits of corporates are typically largely in the form of cash credits and overdrafts.
Yes.
Demand loans there is an optionality in it effectively, and it's a free option for corporates vis-a-vis the banks.
Yeah.
So, the work group itself has strongly suggested that part of the working capital has to be sourced by market borrowings.
Okay.
So, unfortunately, that also hasn't at all been dealt with here, because that would have certainly broad-based, the issuers. But I think one positive certainly is this credit enhancement by banks. I do think it's slightly more than what it looks like immediately.
Okay.
It will probably lead to more borrowers being able to access the corporate market.
Okay. Well, Mr. Khajuria, your final thoughts?
Yeah, I think taking it forward from what Manoj has said, the expectation was that once again we will come back to the WCDL system and all. And it's not that this was to be introduced for the first time. We already had in India in 19, wherein cash credit was not to be given in the form it's being given.
Okay.
That
is the unimplemented part.
Yeah, 50% of it to be given in the form of WCDL, and that 50% was taken to as high as 80%. And thereafter, was withdrawn. As a result of that, corporate playing one bank against another, they went back to the system. So that's one part. And second, of course, this 7 days thing, minimum deposit period is 7 days. And therefore, this restriction was kept that if corporates have to lend against securities, they can lend for minimum 7 days and not for 1, 2, or 3 days. Removing that, if that restriction has been removed, then I think deposit restriction also should be removed. So anybody can keep a deposit for overnight or 2 days or 3 days. Why only for repo?
Okay, fair enough. Yeah, they should free the deposit market as well. Point taken. Jayesh, last thoughts?
We need to help banks, and we are killing banks' margin if you make overnight deposit rates also to be current account to be paying deposits. So that's just a wild thought. But no, I think broadly, yes, it is moving in the direction. They are looking at it. I think the key challenge is going to be the operationalization of it. I hope the margins on the repo and all that is not punitive. Simultaneously, while we are all talking about getting corporate bonds into repo and stuff, UMR is also going to be a big situation. Uncleared margin rules, that's something one needs to get as we move to Basel III. So that's a big challenge, even for government bonds as of right now. And I think so it's a lot of things one needs to get through it. So it's more about detailing. Broad direction, great, but detailing is one needs to see it.
All right. Thank you very much, gentlemen, for joining me with your quick thoughts. I guess more detailed thoughts will follow when you can read the nitty-gritty of the guidelines put out. Let me wind this conversation by playing out to you an interview I had earlier this month with Mr. H.R. Khan, the recently retired Deputy Governor of the Reserve Bank. He stressed on the importance of developing bond markets, and he spoke about all these issues that he had recommended in his report.
We have now allowed foreign portfolio investors to invest. So now we have, as announced in the budget, now unlisted bond and PTC, they will be allowed to invest. And if you talk of intermediaries, the very, very critical point is market making. So what we are looking at is whether some of the brokers can be market makers, and if they become market makers, what sort of support they can get. So they probably will get an access to repo in corporate bond market, which is not allowed to them. So if they get an access through repo to the market repo, so probably they can make market making. And the exchanges are working out a scheme, and I think it is in advanced stage of being implemented. And the other critical part is some of the instruments we have introduced, they have not really taken up. Take the case of example of CDS. Repo in corporate bond. We try to, for example, in CDS, we allowed few things, it has not worked. In the corporate debt repo, we allowed reduce the haircut, allow CDCP, it has not worked.
So you will allow more partial re-enhancement?
So what we are trying to do is, in the terms of CDS, the main issue which has been stumbling block as per the market is this netting issue involving public sector. Because of that, capital charge increases. So we were in dialogue with government